Welcome back to the Everyday Finance Podcast, where we are working with the everyday person to maintain financial security and establish financial independence. Now, today, Garen and I, we just wanted to actually just share a little bit of information and a little bit of the things that we've done throughout our stock investing careers, all the way from starting out to now. And we think we can really give a lot of helpful insight to anyone that's out there that's got a new stock account or is looking to open one up. And today, we're really going to be talking about how to start and grow your stock portfolio. Now, this is something that can be a tricky subject or something that can be a bit of a source of frustration for a lot of people. And realistically, people will pitch you all these kinds of different strategies, but we just want to let you know what we've found useful and what we've run into across our time.
So guys, don't forget that we also do have that 100 subscriber giveaway coming up. Our next video that we drop is going to be the video that you guys go like and comment on, and we should be picking the winners from that one. So stay tuned for our next video, as it will be the $25 gift card giveaway video. Now on that note, let's pump into this. We're talking about the building and growing of your first stock portfolio. And I think the hardest part for everybody is actually growing up and putting money into an account and saying, you know what, I'm going to start investing. So I believe the hardest thing is to actually start. Once you get started, you start adding money and building up your cash and start looking into companies and doing your own research and seeing what you find as a sound investment. But that first step is where I believe 60% of people kind of just get choked up on. And I don't know what you think about that, but it's really just starting up.
Yeah, I actually couldn't agree more, because getting started, I started out slow. Even though I was committed to investing, I wanted to invest, but I did start out slow. And that is the step. And if, for you to stomach the risk, that's what you need to do. Go ahead, just put in the minimum, whatever you can afford, or maybe it's the minimum for the accounts, but it's the most you can afford. But just start it out. Just get it. You don't need to put it directly into a company. Just get the cash in there, let it clear. And, that's part of it. You can just have the account, watch the market, start looking into companies. And what I recommend is precisely that. If you don't know about investing and you're worried, you're scared about losing money, just start the account, just like a bank account. Because if you decide you don't find any companies you like or you're too scared, you can just take it out. But, make a regimented schedule. Because what's helped me the most is just being consistent. Because ever since I started making monthly contributions. I started putting in a regimented amount, and I've raised that amount too, because I decided, I want to add more in here. And that's the biggest thing, because instantly, maybe you start your account with, $500. And if you just decide, I'm going to put in $500 every month, before you ever start investing anything, well, you're already building the account. And that's actually puts you in a perfect scenario to start scooping up some of your first stocks. Now, that consistency has helped me in more than one way, specifically because of strategies that I've implemented and also strategies I haven't. Like, there's many different strategies, and we won't go too crazy because this is about, starting out and getting growing. But it's another thing. There is great strategies out there. Timing the market is something that can be very effective for you. Just buying and holding for the long term, just pure diversification could be a big thing. But regardless of any of that, the consistency's helped me without timing the market, because when I have extra buying power, when I have extra cash in my account, because I add every month and I don't always buy every month, then there's extra cash. If the market all of a sudden goes down like it did in 2020, like it did in 2018, well, I had cash on hand. I was able to buy great stocks at low prices, and I did really well. So if I could say anything to someone starting out new, I would say pick a number, the smallest one you can stomach at first. And just commit to putting that in every month. And if you can stomach a little bit more, put it in there. Or if you got a little bit extra on your paycheck, put it in there. And just keep going, keep continually. You don't need to buy the same stocks every month. Don't worry about it. Even if you haven't bought anything yet, just keep adding into it. Get in a consistent schedule, because it's accounted for in your budget. You don't need to worry about it. You don't need to run around when you decided you wanted to buy a new stock and get some more money. And that's honestly the biggest tip I could probably give.
So I always get asked the question, how much money do I need to start a stock portfolio? Where do I even start? Do I get charged a lot of money? What's going to happen? Oh, the world's ending. Basically, very simple answers to all of this. So to start your stock portfolio, you really don't need much. You can start putting in $5-10 as a minimum, and then just plan on making monthly payments into your stock account, kind of like a car payment, a rent payment, anything that you have as a bill, your phone bill, take it as that. Oh, I'm going to put $25, $100, $200, $300 into my stock portfolio every month. And then from there, over time, you can increase that amount each year that you're invested. Now, on top of that, the portfolio that you have really doesn't have to be super serious when you begin. And I don't mean, just FOMO your money into something that you don't know, or YOLO your money into some stock that your friend told you to buy. I mean, in the actual portfolio aspect of it, you can start using a lot of free like trading platforms, kind of like Webull, kind of like TD Ameritrade, and Robinhood as well. And I know Schwab is now doing a whole free platform now as well. But it's really just starting. Kind of just dip your feet in the water, start the portfolio, put in all your information, get your account approved, and start placing money into that account, kind of using it as an essential savings account. But this is going to be your seed. You're planting your first seed into wealth. You're going to grow a massive wealth tree that has any kinds of investments and any kind of money that you can imagine, but it all starts from somewhere. And nowadays, if you're not investing, you will not be able to build your wealth.
Certainly, and I think that's a great point that you mentioned about planting the seed, because I want to set people up for realistic expectations. You look at stuff on the internet and you see people trading cryptos, trading stocks every day, and they're making great money. And it may seem like to some people, all you need to do is throw $1,000 in an account and all of a sudden start trading that and you're making $1,000 a day. It's fantastic. And I want to set you guys up for success. I don't want to, just get you all excited so you buy my course. Realistically, look, don't get discouraged if you start your account and you don't start seeing crazy growth. It's probably not going to happen like that. And if it does, don't get too excited either. You need to be careful, because I actually see the biggest mistakes in stocks right after someone makes a really big win. Because all of a sudden you make that first big win, you feel like, you're on top of the mountain, you're king of the hill, you're Warren Buffett, So keep your expectations reeled in. You can make fantastic returns. And actually, I want to give you something a little more encouraging besides just that, is, you can actually make far greater gains when your account is small. And that's just because it is small. You don't have, $100 billion spread out between, 260 different companies, like these holding companies. You can invest in just one company. And that's one thing I'd also recommend for growing your account. Don't get caught up in all the by the book stuff. I know there's lots of great investors out there that are doing fantastic, and there's plenty of smart people that went to college for many years to learn this stuff. But just know, if you have $600 in your account, you don't need to worry about the diversification strategies they've been talking about, how you need 13 stocks, or this guy says you need 25, or this guy says you should never have more than 10. Don't worry about it. You can totally invest in just one stock at this point if you want. You can worry about that later. And honestly, I would not even tell you go crazy with your diversification until you have more than $5,000. You shouldn't be worrying yourself about it. But at the same time, you don't need to invest in one stock. I like investing in other ones, and it works out great, because even when my account was small, stocks go up, stocks go down, but it was always a few of them that brought me my main gains. So focus on the ones you care about. Don't be buying a bunch of crap because you think you need extra stuff. You got too many tech companies, so now I got to go buy some other companies in different sectors. Don't worry about it. Just focus on yourself, focus on the companies you like, especially if you're going to hold them for the long term. Just scoop up those companies. You can put all your money into it because your account's brand new and you're about to make a new deposit, which is, if it's your first deposit you've ever made, the next one's going to double your account, and then the next one after that makes your account go up by 50%. And, it works out great like that. But don't get too carried away with the advice that people give you, because there's a lot of stuff that works great for managing large accounts. And you just need to know you're not managing a large account. So you don't need to go crazy. You don't need to make the most ridiculous plans. And if you're only buying 2 stocks, don't worry what those guys are talking about, dollar cost averaging. Like, just focus on the companies, learn the market. Because for me, when I started caring about the market and I started looking into companies, and it wasn't just about day trading, making a quick dollar, then I started enjoying my companies. I started liking my stocks. I started holding them and making fantastic returns.
Yeah, I think you're 100% right about not worrying too much about the diversification aspect when you're first starting. I'll give you an example. So I started helping my mom a little bit with investments a little while back, and we actually started her account with $2,000. With that $2,000, we only invested in 1 to 2 stocks with 50 to 75% of the money into each stock. Basically, so that, if that stock goes up, high risk, high reward. But that was kind of what elevated this portfolio. We saw about 120% gain in about 7 months of the portfolio's life. So it goes to show that you really don't need a set trading strategy when you first start. You don't need a set dollar amount when you first start. You really don't need the most information that anybody possibly can have on the stock when you first start, even though that would be nice. It's really about making that leap, the actual start of it. And then as you start putting more money into it and investing more of your time into it, you start researching your companies and building up a liking for the businesses that you're placing your money into. I mean, it is an investment after all. So you should be somewhat familiar with the companies that you're investing in, and you should have some sort of, at least in my opinion, relation to that said company. I'm not going to go off and tell you what stocks to go out and buy, but personally, I like Kraft Heinz. I'm invested in Kraft Heinz. And the reason for that investment is solely because they are an everyday retailer. You'll go out to Walmart, Publix, Whole Foods, Kroger's, whatever your retail store is, or your grocery store is, and you'll see on the shelves right next to the store brand, immediately right to its right is going to be Kraft Heinz. And that's for mac and cheese, that's for ketchup, that's for mustard, whatever you're looking for. Kraft Heinz is really in that grocery space. So this is something that's had an impact on me solely because I went one day to the grocery store and I was walking around and I was like, wow, this ketchup says Heinz on it. I looked into the stock when I got back home the other day, kind of a stupid story, but I looked into the stock and then I started doing some research and I noticed they actually own a lot of brands that are all under the conglomerate of Kraft Heinz. And really what caught my attention was the dividend aspect of it. So there's a lot of things you're going to have to look out for when you're first investing, but don't overwhelm yourself. These are all learning things that you're going to build up over time with experience. So really start your portfolio, get out into the market and start putting money into it, and just start looking around, browse around, kind of like you're shopping on Amazon or you're walking around the retail store, looking around. You don't really have anything said that you want to buy, but just shop around. Take a peek around at the stocks, see what you like, which sectors are doing well, what's performing at the capability that you want, the companies that are making the decisions that you want. Look at these things because these are all going to be tellers of what other investors are going to be doing as well. Now, that's kind of the big basis of stocks to begin with. As Alex likes to say, stocks are a measure of consumers' fear. So, of course, if the market is more fearful, the stock's going to reflect red, meaning it's going to go down. If there's a lot of trust in the market and there's less fear, the stock's going to be green and it's going to go up. So you got to look out for some of these things when you're investing, but don't drown yourself in the nitty gritty of every single trading category or aspect that you could possibly think of from textbooks or from YouTube or whatever it is. Don't bug yourself with all that stuff. Just start. Trust me, it's the best way to do it.
Definitely, and actually right off of that last point that you made about it not bogging yourself down, overloading with all this information, I just want to touch on that again. And if I could give one more piece of advice, if you're here looking for advice on how to grow your account, how to start off successfully, this is just one more piece of what I think is fantastic advice that has affected me a lot. Is, now trigger warning, cover your ears, don't be a slut. Okay? Look, there's all these strategies out here. There's all these ways to invest. Don't get into stock investing and dabble in everything at once. You can crypto trade, you can, just day trade stocks, you can swing trade, you can buy and hold, you can do options, you can get into margin. Look, pick a strategy and learn about it. Enjoy it. Follow some people on YouTube that do that strategy on the daily, and just focus on it for a little bit. Focus on it, start to learn it, try it out, but don't be doing everything at the same time. You're going to get yourself distracted, and realistically, while you may think you can do it, I'm going to just say, you definitely can. And there's investment groups and teams that do stuff like that, but they have different people doing all those different forms of investing in their different sectors where they specialize. So if you really want to get into day trading, go ahead, go for that. And, start learning it, start picking the stuff that you want to day trade and you want to watch. But while you're doing that, maybe you shouldn't be doing options trading as well, unless you're just trading those options. Don't go too crazy. Like Aaron said, don't overload yourself. Just focus. And it goes in the same way with picking your strategy with the companies. Like I said, don't diversify like crazy. When you just started your account, you don't need 25 stocks. Just because you can buy the fractional shares on Robinhood doesn't mean you need to create a new S&P 500 in your portfolio. Just pick the best companies. I'm sure all those companies are great, but think about it. If you could pick a list of just going through the stock market, looking at all the companies, pick a list of the top 100 that you like the most. Instead of buying all of those, pick the top 10. Pick the ones you think are going to perform the best and go with it. And maybe you're wrong too, but that'll be a learning experience that you get. And really, you'll be able to solidify those gains. You'll be able to perform better if you just pick the best companies rather than taking the whole bag.
Now, I don't think this is just stock advice. I would also like to think of it as life advice. Don't ever spread yourself too thin. That reigns very truly in the stock market, because you could put 1% of your portfolio into every stock that you could possibly imagine, and you can have a portfolio of, like you said, 100 stocks, but the growth of it might be limited due to that diversity. So pick a few stocks that you really like and use that to grow that portfolio. Now, building your portfolio is very easy. I said before that you should pick some stuff that you really know about. That could be whether you like gaming, stocks like Tencent or GameStop. Please don't crucify me. I personally do not like GameStop. But, there are stocks in every single field you can imagine. You like pets, you got Chewy. You can even look into Lemonade, which is now offers pet insurance through the company. There's a lot of routes that you could take. So my recommendation would be to pick a route, pick a sector, and then dive deeper into that sector to kind of find the best performers. Now, this doesn't mean this stock performed the best in the past 3 months. Let's put all our money in it and hope for the best, because that stock that could have been performing great in the past 3 months could also absolutely violate your portfolio and drop you 60%. Trust me, I know, I've been there. Funny story, I'll actually pop into it. September of 2018, right when I turned 18 years old and I was able to start trading, I sunk about $1,500 into my portfolio. About 2 months into trading, I lost 60% of my portfolio, pulled all my money out, and said, I will never do this again. Now we're here. I am a co-host on the Everyday Finance podcast, and I'm still trading today. So it's really starting and doing your research and understanding what you're getting into. The reason why I lost my money at that time was solely because I spread myself too thin. I started looking at the cryptocurrencies that were coming out. I started looking into options calls, margin, and I started looking at a whole bunch of different sectors that I didn't even have really the money for. Owning 0.00001% of a company really doesn't mean. So it's a matter of putting your money towards something that you believe in, putting your money towards something that has actively good performers, and that's indicated through their financials of the company and the vision, and putting your money towards something that will actually provide you something in the long run. A stock right now might be booming because it just IPO'd, which means initial public offering. It just came out into the stock market, is now offered for investment. A stock could just IPO and it can skyrocket the first week, and you're like, you know what, let me invest. But the company can have no money, it can have no properties, and their financials look like a mess. And immediately you're going to lose all your money because investors are going to get to know this. So don't spread yourself too thin. Really just tie yourself together, even though you're very excited about opening your portfolio and getting started on building your wealth and really, making money over time. Don't get caught up in all that. Don't spread yourself too thin.
I couldn't have stated it any better, actually. And I think that's probably a perfect place to leave off. So, I just want to go through a quick rundown of some of the stuff we talked about. First of all, growing your stock account, just get started. Just start it up. Doesn't really matter. And then second, be consistent. Keep adding money into it. Keep checking the stock market. It doesn't need to be every day if you don't want to be active. Just come back to it. Be consistent. Make an investment plan and make it consistent. Next, Garen said, don't spread yourself too thin. Don't go crazy looking at everything. I think that's a big detractor. And, next is you're a new account. You're a new account and you aren't governed by all the same rules and strategies that these massive accounts will do. So, play it out. Find the companies that you like, just learn the market. And don't get caught up in thinking you're doing something wrong because, some big bad investor somewhere told you that, you need to have 20% here or else you're messing up in life. Like, don't worry about it, okay? Just start, invest consistently, pick the best companies, and your account is just going to grow naturally over the years. And I think if you get back into investing, if you stay in investing like Garen did, you'll just see the rewards everywhere and you'll realize how valuable this is. And I think you won't ever give it up if you really just get started. And with that said, I just want to mention to you guys that remember about our upcoming 100 subscriber giveaway. Make sure to like, comment, and subscribe to be entered in that. And with that said, thank you for watching the Everyday Finance Podcast, where we are working with the everyday person to maintain financial security and establish financial independence.